Hey, it's Chris with Life 180, and I'm so glad you're here. Check it out. This video, I'm gonna be talking about why paying off your mortgage is one of the greatest mistakes that you're ever gonna make in your financial life. You can see all my notes. I just got done filming this video. I'm super excited to share this with you. Tons of great content. I talk about how inflation impacts you, how 15-year versus 30-year mortgage, so you have complete clarity about that, paying cash versus financing it for as long as possible, the opportunity cost that goes along with your home, how the fact, how having more control of your money, because let's face it, your mortgage is the greatest asset. It's more money is gonna flow through your home if you're the average American than any other asset that you ever have in your life. So I want you to watch this video to make sure you have complete clarity how you pay off your home in whatever way you decide is going to impact your long-term goals with your money. So stay tuned. I hope you enjoy. Let me know if you have any questions. Hey, what's going on, cash flow hackers? It's Chris with Life 180, and in this video, I'm going to be talking to you about why paying off your mortgage is probably the worst financial decision that you can make in your financial life. You can see I got my board right here. I'm going to go through all of the most impactful reasons why paying off your mortgage is a massive mistake, what you should do about it, how you should change how you work and run your finances through your home, and ultimately how if you make these changes, it's gonna give you literally hundreds of thousands of dollars more in retirement than you would have if you pay off your mortgage faster. So let's just get into this. I'm gonna start by zooming into my trusty outline here. Let's talk about inflation. Let's take the average home right now with about a $2,000 monthly payment. Now, inflation, how does it impact your mortgage? How does it impact your mortgage payment and your cash flow and the purchasing power that you have in your life? Because let's face it, our home is typically, for most people in America, the home is the biggest asset that you're ever gonna own. It is where more of your money goes through than any other asset, any other expense in your life. And so at $2,000 a month with 3.95% inflation rate, think about it this way. That is the inflation rate that we've had since 1970, since we went off the gold standard. That is the average rate of inflation. Now, I know the Federal Reserve says they like to make their target inflation 2%, but history shows that it is 3.95%. So what does that mean? That means 30 years from now, you're still gonna be paying this $2,000 a month, but because of inflation, it's gonna feel like $626 in today's money. Now, what does that mean? So think about it this way. Let's go back, that's 50 years ago. Let's go back to 1990. If you had a $2,000 mortgage payment in 1990, it felt like a lot more than $2,000 feels today. It's that same exact principle. If you got a mortgage in 1990 and you paid out till 2020, when you made your last mortgage payment of $2,000 then, it felt like a lot less in 1990 dollars, right? And so that is the concept of inflation. So think about it this way. Ultimately, every single year, you are running your mortgage, making your payment, that $2,000. Starting year two, let's look at it this way. Right now, today, we have 8%, just over 8% inflation. How does that impact your mortgage? You got a mortgage last year at $2,000. We have 8% inflation last year. That means that your mortgage is still $2,000, but that 8% inflation makes it so the purchasing power is less. So you basically get $160, 8% of $2,000 is $160. So you're paying the $2,000, but it's only gonna feel like $1,840 of purchasing power because of that inflation. So you effectively get a discount on your mortgage because of inflation, and that's just year one. So this is where inflation is happening. This is the value of owning a home in a highly inflationary environment, because of the fact that if you can lock in this fixed rate of $2,000 and then get effectively a discount every single year because this is fixed, everybody else around you, as real estate's going up in value, as people are renting, rent prices will go up and mortgage rates stay the same. So this is where I love cash flow investing through rental properties, because it puts you as the landlord in the position to take advantage of all the benefits of an inflationary environment. And meanwhile, owning a home as a primary residence is a good thing as well. So this is the first reason. This is not the only thing. I just wanted to start here, get you to understand the impact that inflation has on your mortgage. And this is the first component of why paying off your mortgage would be one of the greatest mistakes that you'd ever make, because you get these discounts along the ways, and it controls a lot that's going on in your life. Now, let's get to the next level here. Let's talk about opportunity costs. Opportunity costs here we can see, I want to walk through some assumptions with you. So let's walk through the assumption of, let's take a $350,000 home. Today's interest rate environment is 5.5%. Let's assume either a 0% down payment, or let's just assume the amount financed across the board is 350 grand. Let's do a 30-year mortgage. Let's do a $1,987 monthly payment, right? So if you finance $350,000 at 5.5%, you can look at the principal and interest is going to be $1,987. So what does that mean? The principal and interest right here is going to be $714,000. What does that mean? That means you are going to have an interest expense of $365,414. This is the reason that people like Dave Ramsey and Susie Orman will tell you pay cash for your house if you can, because you want to avoid this interest expense. You want to avoid this $365,000, because let's face it, this interest expense is more than the dang cost of the house, right? So like it would only make sense if you follow that logic that you would want to avoid basically paying for two houses when you could just pay cash and buy one, right? Because that just is what it is. But this is why I titled this opportunity cost, because the opportunity cost of paying cash is significant. If you follow this logic, you would agree paying cash is the way to go. However, I'm going to show you how paying cash is a mistake, because if you took that $350,000 instead of paying cash, you went out and you saved that money, and you saved it, and you only earned 4%, and you did that on a guaranteed basis. And believe me, there are products out there that will do this, and if you want to reach out to me, I'm happy to connect with you and help you and connect you with somebody on my team that can show you how to implement this in your life. But you can do that on a guaranteed basis. This is saying that $350,000 over time is going to grow to $1,159,000. Now, I don't know about you, but when I look at the principal, you're basically, instead of spending $715, and avoiding that $365, you're going to take that on, and you're going to instead just save that money, have $1,159,000. When you back the $715,000 of expenses out of that, what happens is you basically have $444,583 more during retirement. This is more money that's in your pocket. This has no indication, no ramification, no consequence to your cash flow, right? This is not impacting your cash flow in any way, shape, or form. This is simply, we're doing this by increasing your financial efficiency, simply by understanding how opportunity cost impacts your money. Because the key concept here with opportunity cost is when you spend $1, you don't just lose that dollar, you lose what that dollar could earn for you once you give up control of that, right? And your home is not a good place to store your net worth. It's not a good place to store your value of your life and your retirement funds, because, and I'm going to get into a little bit more on why that is the case, but when you understand this principle, let's take it to the next level. Whoa, zoomed way in. Let's take it to the next level. So now we understand $350,000 instead of paying cash, you do want to finance it, right? But here's the deal. Let's say you're still struggling with this. Let's say, hey, Chris, I don't got 350 grand in cash just kicking around to pay cash for a house, whereas most people don't. Let's face it. Let's talk about Dave Ramsey's favorite conversation, which is basically 30-year versus a 15-year mortgage. So let's go into this and say, okay, Dave Ramsey would tell you, once again, paying cash is ideal, but the second best is he coaches people all day long. Never get a 30-year mortgage. Always get a 15-year mortgage and pay that puppy off as fast as you can. This is something that the older generation really believes. My father-in-law, of all people, really believes that this is the way that you should pay off a mortgage. To this day, he believes that. Why do they believe that to be the case? Because in the early 80s and the late 70s, mortgage rates were 15, 16, 17, 18%. It's a very emotionalized thing, and there's some reasons why maybe you want your house paid off, from an emotional perspective. But the bottom line is, mathematically, if you understand how to manage your finances, it just makes no mathematical sense to do it. Let's look at the numbers and just talk about it. So we got a 15-year and a 30-year mortgage here. Both of them are $350,000, right? So that's good. A 15-year mortgage is going to have a 4.75% interest, where a 30-year mortgage is going to have a little higher of an interest rate, right? It's going to be about a 5.5% interest at the time I'm filming this video. Now that said, 4.75. Yeah, look at it. It's a discount. You're going to get a discount on the mortgage from a rate perspective, from an APR perspective. Now, the payment is $2,722 on a 15-year mortgage because that's going to pay it off faster, whereas the payment on a 30-year mortgage is $1,987. So that is a difference here of $735. Now, that $735, I want to circle here. That $735, what do you do with it? Now, you're going to have free and clear cash flow. You're going to be able to do more with it. But here's the deal. If you were to take that $735 and invest it in an account where you only earned 6%, that mortgage is going to be paid off faster. It's going to be paid off in 14 years and 7 months, right? So it's about 5 months faster than the 15-year mortgage will be paid off. But it's not even about just the fact that you're going to pay off the mortgage faster. It's about the fact that you're going to have more control of that money in the process, right? Because here's a principle to understand. I'm going to get over here now. There are a lot of benefits of having a mortgage, right? So when you have a mortgage, especially a 30-year mortgage versus a 15-year mortgage, you're actually going to have much more in mortgage tax deductions, right? So if we went out with the assumptions that I used to build this whole model out, over a 30-year period, you're going to get $109,000 in tax deductions in a 30-year mortgage versus in a 15-year mortgage, you only get $42,000. So not only are you going to end up with more cash doing it the way that I'm coaching you to, you're going to end up with more tax deductions, which is going to put more money in your pocket, which if you were to reinvest the spread there, I didn't do the math on that, but I only know it makes things better. That's what I can tell you. So the other component here is you're going to have more control of your money, right? When we talk about more control of your money, what are we talking about? This amount of money of like, let's say you pay off your house in year 15, you go the 15-year mortgage route and you pay off your house in year 15. Well, all that money is in your home, right? Period. So when we go to the uncertainties of the world, you have less security when your house is paid off. Why? Because you may not realize this or not, but unless you have the right umbrella coverage, the right, I guess, P&C coverage to make sure your home is covered, you have umbrella coverage above and beyond that, your home is now an asset that you own completely, whereas when you have a mortgage, it's technically, legally speaking, a liability. So if anybody gets hurt on your property, if you get into a car accident, if anybody needs to come after you personally, that home is a liability for you because they can come after it and sue you and take your house from you. That is something that is important to understand, whereas if you have a big mortgage on it, it's a liability. And so you're less secure from that perspective. Yeah, you don't got to make a mortgage payment, but I think the key thing to understand there is, when is your house paid off? Your house is not paid off when you have no mortgage. Your house is paid off when you have more security, when you have enough money in an account that's dedicated and allocated to making sure it's covering your home expenses. When you have enough money in that account to pay off your mortgage, that's when, in my opinion, you are mortgage free. Now, you're still gonna have your mortgage payment, you're still gonna have a mortgage technically, but you're gonna be free and clear of the weight and the burden that mortgage brings to most families, because you're gonna have enough money in a side account that you could just stroke a check anytime if you decided to pay off your mortgage. Now, you're never gonna do that because, as I'm showing you, it's inefficient to do that, so you would never wanna do that. But the bottom line is, you have more security when you have a mortgage, because it gives you that protection, but it also protects you from uncertainty, it protects you from disability, and it protects you from job loss. Why do I say that? Because in year 15, or let's say year 12, let's just call it year 12, you get disabled, you lose your job, the market goes into a downspin and we go into a recession, you lose your job and you don't know how you're gonna pay off your mortgage, you don't know how you're gonna make your mortgage payment. Well, did you know that that $350,000 house that you bought 12 years before that probably is worth 500 plus at this point in time? You probably only owe, I don't know, 70 or less on that house at this point in time. But the bottom line is, all that equity that you have in there, you're not gonna be able to tap into, because if you become disabled, if you lose your job, if you're not employed, you're not gonna qualify for any kind of refinance, cash out refinance, home equity line of credit, anything of that nature. So the biggest asset in your life, where you probably have, if you're like most Americans, where you have most of your net worth tied up in the value of your house right now, over 70% of the net worth of Americans is held in the equity in their homes. Think about that. That's a scary number. So if you need access to that when you need it, in emergency and a retirement or whatever, you are at the disposal of whatever the bank says they're going to give it. That is not your equity, that is theirs. So let's say you're 12, something happens to you, you lose that job, you can't make your mortgage payment, you lose it to foreclosure. You've paid $400 something thousand on that house, right, over that time, and you now, you know, because you were just hammering away, you've put your life, you've put that $2,722 a month into this place, just trying to pay it off, trying to follow Dave Ramsey, trying to get to year 15 and have it paid off. When something happens to you there, now you're not in a position where you can weather the storm, right? And when that happens, you're exposed. If you lose your house there, you got nothing. Whereas if you follow what I'm talking about, because you don't have control in the 15-year mortgage, you don't have access to the capital that you would otherwise. If you follow this, not only are you going to have the house paid off faster, but all the money in this side account, this $735 that you invested at 6%, that's going to be sitting in a side account, right? All this money you're going to have access to. So if you needed to keep making your mortgage payment out of that side account, you could. It can be an emergency fund, it can be an opportunity fund, because Lord only knows, we don't know what's going on, how it's going to all act. But let's go back to this principle right here. If we back it out a little bit more, yeah, you're not paying cash for the home, but let's just say we take that $735 a month and we put it into a same savings kind of plan that we did over here at 4%, you're still gonna wind up more efficient. You're gonna have more money. How much more? I don't know. That's gonna depend on you and your situation, how much you're able to save, what your mortgage payment is, what your whole world looks like. But the bottom line is, to me, this is what it comes down to. It comes down to more tax deductions, more control, more security, and more of you achieving what you want to achieve in a more predictable basis, putting you at the center of the results of that, right? And eliminating all the other variables. The reality is, the house, your home, primary residence, for most Americans, once again, is the asset in your life where more money is going to flow through it than any other place in your life. And so you can either utilize that to really leverage it as that asset to make everything in your life better, to give yourself a heck of a lot more money, right? To give yourself a heck of a lot more money in retirement. Or you could just do it like everybody else does and just kind of scrimp and scrape and get by. This is one of the reasons that I say Dave Ramsey is great if you want to be middle to lower middle class. If you're happy with that, then go ahead and listen and follow what he's saying. But if you want a different way, I really encourage you to think about this in a different term, because you deserve this. I think it is your right to make sure that you have more tax deductions to take advantage of the tax code. I think it's your right to have more control of your own money and your own assets. I think it's your right, because you work so hard, to have more security in times of uncertainty, in times of political uncertainty, market uncertainty, all these things, in case anything tragic happens to you with disability, or in case you lose your job in a market downturn, or for whatever reason. I think it's your right to set yourself up to be able to do all these three things. And so if you have any questions about it, comment in the comment section below. I'll do my best to engage with every single one of you. And you know, if you haven't already, make sure you follow the channel, hit the subscribe button, click that bell, that way you're notified every time I launch a new video. And yeah, that's it. I hope you found value in this, because this is really, really important stuff. If you get nothing else out of everything I film, this is one of the most important concepts that every single person in the world needs to understand. So till next time, have a blessed, inspirational day. We'll talk soon. See ya.